What if a single mom in rural Kentucky, with no credit history but a perfect record of rent and utility payments, could get a fair auto loan in minutes, not weeks? Or if a Black-owned startup in Atlanta qualified for SBA funding based on cash flow patterns, not just collateral? That's the promise of inclusive AI in fintech, and it's already unfolding across America. Traditional credit scoring excludes 45 million U.S. adults, disproportionately impacting communities of color and immigrants. AI is changing that not by lowering standards, but by expanding the evidence. Startups like Upstart and FICO's UltraFICO now analyze alternative data, bank transaction history, on-time rent, even educational credentials, to assess creditworthiness with 27% higher accuracy for thin-file borrowers. In a Federal Reserve study, these models approved 22% more Black and Hispanic applicants without increasing default rates. This isn't charity, it's smarter risk modeling. Fraud detection is undergoing a similar revolution. Legacy systems flag transactions based on rigid rules, triggering false declines that hit marginalized users hardest. Modern AI, like those used by Chime and Vero, analyzes behavioral biometrics, how you hold your phone, swipe speed, even typing cadence. One pilot with a CDFI in Chicago reduced false fraud alerts by 63% for low balance accounts, meaning fewer frozen cards when families need groceries most. But real impact happens at the community level. In Detroit, a nonprofit credit union uses AI to scan small business bank feeds and auto-generate personalized financial health reports, highlighting cash flow gaps, suggesting invoice timing, and connecting owners to micro-grants. One salon owner used insights to shift payroll day, avoiding $120 in monthly overdraft fees. That's financial intelligence as a service, not a privilege. The CFPB is watching closely and pushing for accountability. New guidance demands adverse action explanations in plain English. Your loan was declined because income volatility lasts 90 days, not because of your zip code. And tools like Mozilla's Lending Transparency Toolkit let developers audit models for disparate impact before launch. Yet challenges remain. Black box algorithms still dominate, and data gaps persist, especially for gig workers and informal economies. The solution? Federated learning and participatory design, like the FDIC's Tech Sprint, where consumers co-build tools with engineers. This is how America builds a financial system where opportunity isn't determined by your starting balance, but by your potential. If you believe finance should lift people up, not lock them out, hit subscribe, like, and share this video. Tap the bell icon because in Part 2, we'll reveal how AI is powering the next wave of community development, detecting predatory lending in real time, and why the Treasury's new AI for Financial Inclusion sandbox could change everything.